I don't think any additional introduction is necessary, but what we wanted to do before we start is a little, if you guys have your phones, just you go to the, if you guys have your phones to get out, just a little, so with the One Big Beautiful Bill Act, there's a couple questions we just want to get audience participation with. The insurance industry, there's not as much in the bill that's really specific to corporations insurance. And so I know you guys also probably have your hands in other businesses, but there's quite a wide range of topics. And so one of the questions we want to figure out as we go along is what do you guys want to talk about? Because we could go through the slides in a linear fashion and just one after the other, but we do want to make sure we hit on things that are most important to you. And so there's going to be a little survey that you can take and say, hey, you can choose up to 3. Here are the 3 things that I'd like to hear about most. And then we'll kind of do our presentation following the most popular topics to the least, and we'll go that way. Okay, so we've got 19 of you in there. We can just go forward. So first, though, just a little icebreaker. I haven't actually used this myself, but hopefully this works. We just want a little icebreaker question. What is a hobby or interest you have that no one in this room would guess? And it's not going to, well, did I write that? Because I would have wrote that too.
We normalize making sleeping a hobby.
It's a hobby when you do it like more than just the nighttime sleep. Yeah, then it becomes a hobby.
All right.
Traditional Irish music, okay. Some of these are great. So then if you see anything, you're like, oh man, I'm into that too. You'll just have to ask around, like who's the one into embroidery? Trail running, I have an idea who that might be. We're more than just accountants. That's the idea here. Archery, that's an interesting one. What's a hobby?
Integrating native wildflowers in my garden. Awesome.
Wow.
Kids take a lot of time. Surfing in Utah.
Surfing, crafting, baking. Okay, well this is fun. Thanks for being willing. We have such varied interests in this room.
He had a very different question to begin with,
I changed it.
Switched it.
I was going to ask everyone what their spirit Star Wars animal was, or Star Wars character, but I actually used the question in another setting and it didn't go super well, so I changed it for this one. So, okay. The next question, you can't really see the topics down here, but on your phone it should be a much easier view. So scroll through, kind of these are some of the different things we can talk about. And it should work this way that once you submit it, we'll start to see like live results of what people are interested in talking about. So there's going to be a lot of broad tax stuff that's not going to apply to your insurance companies. A lot of individual tax related things, but I think there will be a few interesting items. So we'll give some time for the results to come in before we start.
I just read the last choice.
Oh. And it's not anonymous. I'm going to know who chose the last one.
Yeah.
Warning.
And it's probably going to be our auditors. James did it. I know James did it. We'll wait till we get at least 20 responses.
Looks like more than one person did that last one.
Let's see, 19 times 3 is 57.
Yeah.
Okay.
All right, one more. Oh, we got it.
We take a picture of that.
Yeah.
Since we won't be able to come back to this, you'll have to zoom in on the.
Let's see if I
I'll
can.
take one too, just in case. We're going to take a picture of this so we don't, or because we're not going to be able to come back to this. Okay. All right. Great. Thank you for doing that. So, oh look, one last one came in. Oh, now there's a tie.
I better take a new picture.
Want to make it harder for you to decide.
Yeah. Why don't we'll do this. Okay, we've got the results. So it's just so you guys, I know you might not be able to see, but the winning topics were the government shutdown, which we got news yesterday about that. Income tax footnote disclosure requirements, new requirements coming up, other business provisions, charitable deduction limitations for individuals and corporations. That's part of the OBBA, and then some other IRS updates that we thought might be interesting. And then after that, we'll dive into some of the new personal income tax deductions. Some of which, I mean, they're individual income tax things, but for employers, like a lot of, it'll matter, some of the reporting requirements and such. So, Jason, why don't you start with the income tax footnote, and then I can take over from there. Does that work?
That works great.
Okay.
So, at the end of 2023, the FASB issued an accounting standards update 2023-09. It was to increase transparency in the tax footnote disclosure, and to make things just a little bit more challenging to present. But so the accounting standards update kind of delineated between public business entities and non-public business entities. So, but two of the major things for all entities that are now required to disaggregate income taxes paid by federal, state, and foreign tax. I think that can be either on the face of the financials or in the footnote. But then, so for public business entities, they're required to disclose specific categories in your rate reconciliation. And there's some thresholds of if certain items that are listed in that category make up a percentage of total tax, then you have to add more stuff. So there's in the ASU, there's an example of how it's supposed to look in a tabular format, and it can. One of the things that I think can get really cumbersome is if you have multiple states that make up like more than 5% of your tax, you got to list it out by like each state. But the good thing is, the SAPWIG, the Statutory Working Group, did not adopt the public entity only disclosures. They thought it was too onerous for all insurance companies to have to do that. So, but they did adopt for the most part the other provisions of the update. So that's kind of update on that. I thought I had one other thing, but it slipped to my mind. So so timing wise, the effective date is for public business entities. 2025 reporting year. Any year beginning after December 15th, 2024. So basically this 2025 reporting year. For non-public business entities, it's the following year. So if you report, so on your statutory annual statement, it shouldn't be quite as big of a deal, but if you're doing GAAP statements as well, there might be, and I guess if you're, for those that are public entities, which probably doesn't apply a lot here, there's a little more reporting. But check out that update and make sure that your footnotes or us or your tax writers make sure that your footnotes are up to date. Any questions on that? Okay. Our next one.
So it sounds like the biggest update is, hey, I've got to go into my state tax expense. And if I have jurisdictions that have over a certain percentage of my state tax, I now have to list those separately
Yeah.
instead of having one line that's just state tax.
Yeah.
That makes sense.
We're in one line that's just income tax,
Right,
federal
or
and
the-
foreign income tax, and yeah.
Right. Okay, next topic, the shutdown. So this was the original slide we had before. So I'm sure you all know that yesterday President Trump signed a bill to fund the government through January 31st. And so the IRS actually had alert on their website for employees that said, hey, come back to work Thursday, November 13th. Bring your laptops. It was like interesting that you could actually see this communication to their employees. So there will be a delay still in some of the IRS, like they're working through a backlog of, they will be working through a backlog of things. While it was shut down, they were not responding to any correspondence. And so over the last 43 days, there's been plenty of correspondence coming in. They weren't responding to any of that, so they will be working through that backlog. Interesting to note, they weren't reviewing mail, but they were still sending out automated notices. So you might have got a notice,
You probably got, yeah.
responded to it, and then didn't hear back, and maybe got another notice because the system kept kicking out automated notices. But now that the shutdown is over, the real impact will be, can they get caught up so they don't delay filing? I mean, the filing season won't be delayed. All the payment dates, due dates remain unchanged. But I still think over the next little bit, we're going to get slower service. And I've experienced it. It's been harder to get in touch with someone, on the phone lines. And I imagine that will continue just as they work through the backlog. So like I said, the new bill funds the government through the end of January. IRS employees, in theory, back to work today, but we still expect delays. So I don't think there's a lot else. Now, again, now that they're back, the only impact is just expect some additional delays, but hopefully things get back to normal. It was interesting. One of the former IRS commissioners was asked in an interview, they were saying, well, hey, how is this going to affect the filing season? And his comment was, this period of time, basically during the shutdown, is you basically, in the IRS, we need every single minute to get ready for filing season. So he was a little pessimistic about how it would delay filing season. Maybe forms come out late or instructions, because he said every minute counts during basically your October to December kind of periods. And he said on top of that, we have new tax law. Tax forms need to be updated and things like that. And so he was a little pessimistic, but we're hopeful that it's not too much of a delay. Any questions on the shutdown? Okay. What's next?
All right. So we had 30% few. The other business updates. So we've got interest expense limitation. So,
Well, this one's going to be in a few different places. Why don't we start here? So,
okay.
So some of you may know, if your business entity is of a certain size, I think it's average $30 million of gross receipts over 3 years, the amount of interest expense you can deduct could be limited. And this applies to corporations, all types of business entities. The one change they made, so typically the limitation says, give us your adjusted taxable income, multiply that by 30%, and that is how much interest expense you can deduct. And what they changed in the new tax bill was saying, hey, when you are coming up with your taxable income number that you're going to apply that 30% to, we're going to let you add back any depreciation, any amortization, which is going to push that adjustable taxable income higher, so that your limitation is going to be less of a limitation. So simple example, here's a company with $300,000 of taxable income. If they, under the pre-OBBBA rules, their taxable income, not considering interest expense, was $700,000. They would have been only able to deduct $210,000 of their interest expense. But you can see with the OBBBA, I think we're missing a B there, but that's okay. That you're able to add back that depreciation and amortization, and it just bumps up the amount of interest expense you can deduct. So I don't see this a lot with a lot of our insurance companies, but it could apply if you have significant interest expense or are operating in a loss position.
Quick question on that?
Yeah.
You said revenue, you say 30 million, does it include premiums in that?
Yeah. Yeah, so it's all gross revenue. So for an insurance company, it would be premium income. Jason, if we jump back to the main table real quick.
Was there another question?
We
Okay.
can go to
The stock employer.
right down there. I don't know. This isn't really broadly applicable to insurance companies. So I'll go quickly. But small C corporations, there's a provision in the tax code that said, hey, if you form a C corporation, it does not apply to insurance companies. But if you had business dealings elsewhere, maybe you acquired a company or anyway, smaller C corporations, there's a provision that says, hey, if they're of a certain size and you form the C corporation and then you sell it, any gain on that stock that you might recognize, you can eliminate from taxable income. You can eliminate the gain completely and not pay tax on the sale of the stock. And again, it's a pretty narrow provision because it applies, again, to C corporations of a certain size, not insurance companies, and the ownership, it's not broadly applicable to all owners of C corporations. But the OBBBA basically took all of these limitations and said, hey, your C corporation can't be have over 50 million of assets, and they basically took those requirements and bumped them up and said, now if your corporation has 75 million of assets, you could still qualify for this gain exclusion. Again, I don't think it's really super applicable for this group. The amount of gain that you can exclude is greater under the new law, but I'm going to fly through this because, again, I don't think it's super applicable. Let's stick on this one because this one did have a few. Okay. This will apply, I guess, to most of your companies if you have meal expenses or if you have, like we do, on premises snacks and things like that. So under previous law, if you had a kitchen full of snacks, like our snacks in the back right now, historically you could deduct, depending on what kind, if it was de minimis, you could deduct 100% of those snacks, those meals, or if your company has like an on-site cafeteria, basically on-premise food, typically deductible, either 50% or 100%. But starting, I believe this starts in 2026, effective after December 31st, 2025, meals provided to employees on the business premises are now non-deductible. So all of the Costco snacks in the kitchen, this will affect us. We have great snacks in our kitchen. Those are not deductible. So the way I think about it is, like, someone once asked the question, well, what if we go out, take some staff out to a lunch for mentoring or something like that? I think that's still deductible off premises. It's more, what do I have on site for the convenience of the employer, the employees, and that's what's non-deductible now. So I think for you guys, a lot of you guys that are doing the books and in charge of the financial accounting, one of the questions you might get asked, if you have general meals accounts in your trial balance, your CPA may be asking like, hey, we kind of need to dive into this line item. How much of this is meals with clients? How much is food on site? Because there is going to be differing treatments of both. So, and again, this doesn't apply until 2026, but one thing you might consider doing in the financials is maybe adding another line item on your trial balance for the on-site snacks.
So is that kind of what that 100% team building, social outing, and company events, that's more off-site? Or is that?
Yeah, yes. And the company events could, if like a Christmas party, if you have that on site, then I think that's still 100% deductible. It's more, the way they phrase it is for the convenience of the employer, like, hey, we've got these snacks on site so they don't have to leave to go to lunch, they can stay here. Or we have a cafeteria on site. I think if it's...
We just need to be team building all the time.
Yeah.
just constant team building. And I think with the company event thing, usually it's like, hey, we've got a big event, everyone's invited. That's 100% deductible. I think it's different than like small groups, right? Doing team building.
We've invited them all, we just didn't tell them.
Right. Yeah.
They missed that.
Yeah.
Come on over.
And I'm thinking about our business. Again, the thing for us that gets impacted the most is just, I think a lot of people keep snacks on site, just in the kitchen, for employees to grab when they want to. But I think some of it, and to your point, there could be some kind of like, well, is this, or is. But I do think, if you can see a clear delineation, it would be helpful for tax preparers to have it just to help. It's just going to cause you more headache when we come and say, hey, can you go through this 1,000 line item meal account and tell me which one's which? Just something to think about. Again, this year it doesn't matter. We're still in November, so this would be for starting January 1.
What would you say about on-site training meetings, like training during lunch hour and pre-lunch?
I think that might fall under the disallowance, but I'm not 100% sure.
So more team building and training.
More, yeah.
Is it if it's for the convenience?
Yeah, it's if it's for the convenience of the employer on premises, I think it may still fall under the limitation. So again, what I think of now is we have a staff meeting once a month that we bring lunch in, and that could be now potentially non-deductible in full.
Well, we're gonna start including employees' meals, so we're gonna start taking a head count.
Okay.
Put on your W-2, and then we'll take the deduction.
Yeah.
That escalated.
Yeah. Everything's deductible. So forget everything I said. I think there is some clarification needed a little bit because it's a little, there's not, I would say it's not 100% clear with some of the wording. But the specific examples they do mention, if they do mention examples, it's on-site cafeteria and break room snacks. I think those are like the very clear things that they provide. In between, there may be some gray. Okay, let me jump back. Let's go to the other IRS updates.
Do you want to hit the QBI?
No.
Okay.
Let's go to other IRS updates on the bottom there. So I don't know if I believe this yet, but apparently this is from an Internal Revenue Manual that was released in August. Apparently, it seems to indicate that insurance company tax returns can start to be electronically filed starting in 2026. I saw Steve's eyebrows raised there, like, really? I also am dubious a little bit. We don't have any, there's been no like other news or announcement of such, but it's just in this. These are printouts or cutouts from this revenue manual, but it does seem to indicate that starting January 1, 2026, insurance company tax returns can be e-filed.
We've had in the past, they've said they're going to get to this point, right? But there's not been any big announcement that, hey, it's ready now.
Right. So yes, they have, to Jason's point, they have mentioned like, this is the plan. And I think they even maybe indicated 2026 a few years ago. And I guess we're finally here and it's now in an Internal Revenue Manual. So we'll see what happens. One of the things that we run into sometimes is, for example, if a company is formed as an LLC and when they apply for their EIN, they put LLC as their business entity. Sometimes the IRS will send their EIN letter and it says, hey, we're expecting a Form 1065, a partnership tax return, because you told us you were an LLC. And then we file a Form 8832 to say, hey, IRS, we want this to be a C corporation, not a LLC. But the issue that happens sometimes is if the IRS doesn't have time to process that election to be a C corporation before we have to e-file, we go and we try to e-file it as a corporation because we filed this election form, but the IRS records aren't updated. They still have it as an LLC and they say, hey, sorry, this is rejected. So I do see that there could be some issues depending on, I know most insurance companies are set up as corporations from the get-go, but we do see some that are set up as LLCs and then they convert for tax purposes to a C corporation. I could see issues where there's still like a mismatch between what the IRS has on record and what we're telling the IRS it is. So we'll all see together if this is actually going to work. But I anticipate there will be some interesting things. So we'll have to attach big PDF. You get to attach the big PDF annual statement, which is way better than attaching like your 400-page annual statement and sending a return that's that's huge. So that was an exciting one for us. We were excited to see that maybe we'd be able to electronically file this. The other updates, you probably heard about this in the news. The IRS is going to phase out of paper checks, both receiving paper checks and also issuing paper checks. I think most corporations are already paying electronically, so this isn't a huge deal on the payment side. But I don't think, to my knowledge, few or none of our insurance companies are actually getting like direct deposit refunds. Everything comes in the form of a paper check. What I don't know is whether the new 1120 tax forms for 2025 will have a section where you can add your bank info. Like on an individual return, there's a section that says give me your bank info and then we'll do direct deposit. They haven't released the 1120 tax returns for 2025 yet, but it's possible that they will include a section to add bank information for direct deposit. That's what I am guessing. But until then, the rollout for this is starting with individual taxpayers. Until then, I'd expect to still see paper checks, but I am curious. The tax return is one thing. You file a tax return, you give them the bank info on the return, you get a refund. But what about all the other ways that refunds come? Like if they review a return and determine that your overpayment's more than you thought, are they just going to use the most recent bank information on file to give it to you? Or are they going to send a letter that says, hey, you have a refund, send us your bank info? The tax return is, again, one thing. It's pretty easy to give a return, give the bank info. But what about other refunds? Will they just automatically start going to whatever bank account's on file? I'm not sure. But the idea here is that soon-ish, you'll stop getting paper checks from the IRS. It'll all be direct deposit. But as it says at the bottom, which is cut off, detailed guidance. They're going to give more detailed guidance for this before the 2026 filing season. That's a good example of something that could be delayed because of the shutdown. So we'll see if it comes. I wouldn't expect anything different from the way you're all doing business right now, other than we'll see if there's a section on the return for bank account. Any questions on that?
Can I go to the charitable contribution?
Yeah, let's go to charitable contributions. This one's a little bit funny and weird.
Yeah.
I'm going to start with corporations since that's a little more applicable to us. The individual change is very similar to the corporate change. So historically, corporations could deduct charitable contributions up to 10% of their taxable income. So $1 million of taxable income, you could deduct $100,000 of charitable contributions. So the new law maintains that 10% ceiling. So the most you can deduct is 10% of your taxable income, but they've also introduced a floor, a 1% floor that says, hey, essentially, take your taxable income, times it by 1%, that amount of charitable donations is not deductible. So you kind of lose a sliver of your deductions, your charitable donations for corporations. And we have some examples to kind of help explain this. So, corporation with taxable income of $1 million makes a donation of $5,000. Because that donation of $5,000 is less than 1% of a million, it's non-deductible. Example 2, same taxable income, they make a donation of $120,000. In this case, there would be 2 limitations that apply, the floor and also the ceiling. The floor says, hey, 1% of a million is 10,000, so that first 10,000 is gone. You have $110,000 left. Because that is more than 10% of your taxable income of $1 million, we're also going to shave off 10,000 from the top, and so what you can deduct is 100,000. So that example kind of shows you could get hit on both the floor and the ceiling. So the next question is, well, what about carry forwards? Can I carry this forward if I'm not able to use it in a given year? Yes. So the ceiling you've always been able to carry forward. You know, if your donations exceeded 10% of your income, that would carry forward, and that still remains in effect. The weird part about this law is the floor. So the question is, the part that got cut out because of this floor, can I carry that forward? And the answer is yes and no. And so, okay, let me, well, I'll go here. So the floor can be carried forward only if, and I think this is very strange, only if the ceiling, you were also limited by the ceiling in the same year. But if the floor limited your deduction, but you didn't hit the ceiling, then you can't carry it forward. So if we go back to our examples, that first one, my floor was 10,000. The first 10,000 was non-deductible. If my donation was 5,000, I lose it forever. I can't carry it forward because the ceiling rule never kicked into place. In the second example, we had that 1% floor disallowed $10,000. The ceiling disallowed another $10,000. Because both applied, both can carry forward. Clear as mud, right? I mean, but so, Stephen, yeah.
Any reason why they did this? It seems like it would just discourage corporations from making charitable contributions.
Yeah, it certainly limits it. My thought is, I don't know, it's like specifically why this, but generally the new tax bill, most of the new tax bill is taking Trump's tax cuts, his original tax cuts in 2017, and making them permanent. And all of those tax cuts were really favorable. Like there's a lot of favorable provisions. And my thought was always, how are we paying for these? Because they were set, when they did Trump's original tax bill, they have their budget reconciliation, the way they do it, and they say, hey, these are going to last from 17 to 2025. That's going to be our cost. But then they go, and they try to say, we've got a 7-year cost for these tax cuts. Here's how the budget reconciliation works. But now here we are making them permanent. But there wasn't really a lot of revenue raisers for them in this new bill. And my thought is this is just one small thing to raise revenue, to start to help pay for some of these. I don't know what the motivation was. I mean, things like another big revenue raiser was cutting clean energy credits, that kind of thing. That one we kind of knew was on Trump's agenda. This, I don't know the motivation for it, other than they needed some way to pay for a sliver of the new tax cuts, and I guess this is one thing they chose. But to your point, I don't know what the motivation is.
I'm curious about example 2 in year 2. So say in year 2, you don't make any charitable contributions in year 2, but you have this $20,000 carry forward, and say you have $2 million of income. Now you're below the floor. Does that mean you lose it forever, or do you continue to carry forward for another 4 years?
Yes, no, I have no idea. So what you're saying is in the second year, whatever carry forward you have is below the floor. Does that not ruin it? Or my thought is, I don't know. If I had to guess, because the typical charitable carry forward is 5 years. I don't know.
It would seem like it'd be generated in the years.
Well,
be carried forward. So that carry forward still.
let me think about this out loud for a second. In the second year, when they're doing the limitations, current year is considered first. And once current year is considered, they'll move on to carry forwards. So in this case, you have a $20,000 floor, and you say, I think it might go away. I think you might lose it in that case.
Would you lose it, or would you just wind up still carrying it for 5 years until if the 5 years you haven't used it, then at that point.
Maybe, because again, I have no idea. You may be right, but you could say, well, you did use it. It kind of went towards your floor.
Yeah.
You know, you used it. It was available to you, right? Like you have $2 million of taxable income. You can, in a normal world, without the floor, you would say, I'm using it. I'm going to take it. And in this case, you say, I'm using it, but it's just going to the floor.
Yeah.
Can influence companies to actually contribute more so they don't lose carry forward.
Yeah, it will. I think
Like
one.
if I was a lobbyist trying to appease charitable organizations, that would be my argument, right? Is, hey, well then they'll contribute more so they don't lose their carry forwards potentially, right?
Yeah, and it certainly discourages de minimis contributions, right? Like, if anything, they're saying, hey, don't just do 5,000, do 30,000. So you know. So I think one of the takeaways is if your entity is charitably inclined, but maybe not like super charitably inclined, you can consider bunching your donations, right? In 2026, don't make any donations, save it all for 27 and do a bigger donation in 27 to at least get some benefit, as opposed to doing it in 2 separate years, losing it all in both years because of the floor. That's kind of the recommendation that I see is if you don't want to change your spending to do more, at least bunch and see if you can, in a given year, get over that 1% floor. That makes sense. I'll mention this quickly, just because we all have personal returns as well. A very similar rule applies to individual donations. Well, let me start here. If you don't itemize, if you remember during COVID, they allowed non-itemizers to deduct a small amount of charitable donations. This is coming back. So if you don't itemize your deductions, you can still deduct a little bit of charitable donations on top of your standard deduction, $1,000. But if you do itemize, they have the same floor as corporations, except it's 0.5% of your adjusted gross income. So same example, if your adjusted gross income is $200,000 on your personal return, 1% of that is, what is that? Or 0.5% of that is, do the math for me, $1,000 bucks?
Yeah.
$1,000 of your donations will be non-deductible. Really impacts wealthy taxpayers. If you think about, a millionaire, billionaire that wants to donate $5 million, and let me bring the numbers down. Let's say they want to donate $500,000, but they have $100 million of income. 0.5% of $100 million is $500,000. And so that's a big chunk to wipe away from the ultra wealthy. Impacts us. I'm just putting us all in the same bucket. Maybe some of you are ultra wealthy, but I can say we're all the same. Impacts us less, but I can see how the ultra wealthy, it would really impact their situation. Okay, so that's charitable donations. Let's go to overtime and tips.
Okay.
That one had a fair amount of stuff. So, again, it's the first one. Most of these, I would probably say for this group, you may be thinking about it more from an employer perspective and less about your own personal tax situation. Tips, we don't see a lot in our industry. So I'll fly through tips, but some portion of tips will be not includable in income. The one interesting thing I thought is, if you go to a restaurant and you have a big enough party and they say, hey, big parties like this, we just have a 20% tip included. That is not eligible for exclusion. It has to be the customer has to be able to voluntary, thank you. I probably have that word on the thing, yeah. They have to voluntarily decide, and if it's forced upon them, then you can't exclude it. The IRS put out industries where it applies to. Overtime, how many do you guys have, by raise of hands, when you pay overtime, if you do, is it time and a half? Is it, or is it just time? Because the reason I ask is the overtime applies if that overtime pay is like more than just your regular rate of pay. Does anyone, we do time and a half? Okay, we do time and a half, so this applies. Does anyone else pay time and a half?
So we do a weighted average because they have variable rates.
Okay.
So they actually get a weighted average.
Okay. So, but the overtime, it's more than regular rate. So, with overtime, and maybe you've gotten questions about this already from people, but the amount that individuals can exclude from their income, it only applies to that rate of pay that's above their regular rate of pay. So in a time and a half example, it only applies to the half piece. And this starts 2025, and so that's why I say people may be getting questions about it. Note that it's still subject to payroll tax, even if it's non-includable for the individuals. So I think the interesting thing here is reporting for you guys. Like, how are we going to report this to our employees that have overtime? The fact sheet says employers are required to furnish statements to taxpayers showing the amount of qualified overtime compensation. A notice just came out a week ago that said that there will be no penalties for failure to comply. And the reason they have no penalties is because they said, we're not going to update our tax forms for you this year. So the W-2 will not be updated with a box that says this is where you put your overtime or your tips. And so essentially, because of that, no one's going to correctly furnish the statements as the IRS wants, and so they're giving us penalty relief. So the question then becomes for you guys, what do you do? Like, because the individuals need some information so they can properly take this exclusion on their return. There's not a specific way for you guys to do it this year. So how do you do it? The notice basically just says, you can give it to them through an online portal or through written statements. So basically whatever way you want. But I think the important thing for you is if you have employees that worked overtime and got paid more than the regular rate, there is some way that you should try and give them the information. But there's not a set way this year. But there will be starting in 2026. Does that make sense? So, sorry, go ahead.
They haven't told, or like obviously there's going to be some kind of field or something that they'll have to enter this from this said statement that we write versus the box or whatever.
Yeah.
Right?
So this is the new tax form that's going to be included. And so there's a section here, no tax on overtime, and that's where they'll put in. I mean, I think the big thing for you to give them is, here's how much you got paid on the half, right? Or the accelerated pay. And then they would just throw that in box 14A right there. So the other thing, so this is, it's funny, there's like loads of 2025 tax forms they haven't released, but they have given us the 2026 draft W-2. But in that, there's new codes for box 12 for these items, and one of them being qualified overtime. So in the future, starting in 2026, whoever's doing the payroll function for your company and preparing the W-2s, they would use these box 12 codes to put in the overtime. Obviously, you'd have to give them all the info, but that's the way it will be reported in the future. Okay. Car loan interest, you can get some of your car loan interest deductible as long as it meets certain requirements, one of which is being the final assemblies in the United States. You can find that information out by looking up your VIN number. Anybody 65 and older, there's an additional deduction for them of $6,000. This is not applicable to employers, so I'm going to kind of That guy's really happy about it, though. He's super thrilled about the idea of a new that. Anyway, all these new deductions, overtime tips, senior deduction, car loan interest, all go in this form, as we showed before. And then that's where it would end up on your 1040. Okay. We have time for maybe like one more. Is there any, I guess, we've talked about various items. Is there anything we haven't hit on? If you think back to that survey or the thing you filled out, is there anything you're like, man, I just really wanted to talk about this and we haven't got there yet? Because we can keep going in the order of the results, but is anyone just dying for...
You kind of glossed over just a second ago the senior deduction.
Yeah.
What was that?
If you're 65 and older, the IRS is going to give them an additional $6,000 deduction, just to be nice.
That's probably like adjusted gross income.
$300,000 for married couple. So it's going to apply to a lot of people, and it's a deduction over and above the standard deduction, itemized deduction. So it's in addition to those. So in theory, like a senior couple, both over the age of 65, if you take their standard deduction and tack on a senior deduction, which is $6,000 each, you could end up with a deduction of like $45,000 for an elderly couple. So it's a pretty significant. I mean, it's pretty significant for them.
What year is that effective?
2025. So it starts this year.
It's supposed to be the no tax on Social Security promise.
Right. This is the way they're doing it. And again, if it applies to you and you're doing it, it's going to be right here in this section. Did I say 300,000 earlier? Oh yeah. So the phase out, I was wrong. It's 250. The phase out starts at 150,000 of income, and then it phases out gradually until you hit 250,000 of income. So.
Is that the phase out for individual or married?
That's married.
Married. Okay.
Yeah. Individual is just half of that, 75 to 150. Let me go back here. In case anyone forgot what the topics were. I think we hit on most of the ones that I feel are the bonus depreciation in section 179. You guys are probably aware of this, but 100% expensing of fixed asset purchases is back. So it was gradually phasing down over time. I think we were down to 40% in 2025.
Do they have to be new assets?
No, they can be used as well.
That's effective January 19th of
Oh, yeah.
2025, or for assets placed in service January 19th thereafter.
Yeah.
So if there's anything in the
Yeah, if you bought
1st
something
19th
big, like in the
window-
first 18 days of the year, you're out of luck. It's gonna be 40%, but
Also, just to clarify, if there was a contract in place prior to January 19th, it's not just placed in service.
Oh,
So.
okay.
way to ruin it for us, Rick. Yeah,
Rick's an author.
Yeah.
got the wrong. Okay, I think that's most of the items. Again, if anything on the list is calling out to you, say your piece now. Otherwise, Margot's giving me the warning sign.
That's a smile.
Behind the smile, though. Okay. Well, thank you, everybody. Go ahead, Neil.